Hey, what's up? I'm Russ, and yeah, here we are at Dapper Dividends. It's Halloween time again. And unless you are, I don't know, unless you're one of those weird houses that turns off the lights, hides from everybody that's coming by trick or treating, you're probably going to be buying candy like we're going to be buying candy. Well, actually, unless you are also those lunatics on the block that give out pennies and candies to all the disappointed faces and painted faces and masked faces. Kids, I love Halloween. Look at this. Captain Harlock from the late 70s space pirate cartoon. Fantastic stuff. So I have for you 10 companies that are tied into Halloween that pay a dividend that you can buy to kind of partake into what people are buying and doing for Halloween. And if you're watching this on the replay, thank you for tuning in. And for those of you watching live, we will hang out and chat as soon as this is all wrapped up and done. So we're going to jump right into we're going to jump right into it. So check this out. This is from 2020, came out last year. Instacart's top 10 candy cravings. By the way, I would like to know what your favorite Halloween candy is. Put it in the comments here, there, wherever it is, up, down, I don't know. But check that out. Peanut M&Ms and M&Ms. Those are Mars. Those are not publicly traded companies. Reese's Peanut Butter Cups is number 3. Hershey's and Reese's and Twizzlers are all the same company. Snickers is M&M Mars. Kit Kat, I believe, is cripe, I forget. We'll come to it in a minute. I think that's also Mars. Candy corn is Brock's, owned by Ferrara. Mars and Ferrara are not publicly traded companies. Sour Patch Kids is Mondelez, and Haribo is also private. So that is the first of the first. Number 1, here we go. Quick little display setup here. This is a company. Well, this is a larger company that I had my first costume from. They bought this company, Jewel Osco, here in the Chicagoland area. Everybody knows Jewel Osco. And funny, I got my first costume here. Here I am in 1984 as Bo Duke from the Dukes of Hazzards. That was my first costume, bought at Jewel Osco, right off the rack. And of course, that is Albertsons Company's ticker ACI, currently paying a 1.96% dividend yield. Gets a dividend safety score of 60. Looking at the chart here, I'm going to show you also the year-to-date returns versus the S&P 500, currently down 15.69%. That's small on my screen. I can't read it, god dang it. So they're actually doing better than the market. Currently paying we said 69? I've forgotten already. 20% dividend growth. They just started paying that dividend because Albertsons just recently went public in late 2020, early 2021, I believe. 1 year dividend growth streak. Dividend yield is about 12% above their 5-year average, as you can see right here. Their forward PE ratio is a little bit below, so they look like they're maybe a little bit on sale. Number 2, getting right into it. You'd probably guessed by the big Hershey's logo. I love this company, but I don't own them outright. I only have exposure to them in mutual funds. And let me see if I can make this bigger for my own eyes. There we go. All right, I can read what we're seeing now. Fantastic. Anyway, so Hershey gets a dividend safety score of 93. Very solid company. Hershey's is just wonderful. And what else do you want to tell you about them? 15% dividend growth in July of 2022. 15.66% total return year to date. Now, this includes dividends. Compared to the market, again, it's always going to be down 23%. Hershey's, do you own Hershey's outright? Looking for a good point to buy them. 33 years of uninterrupted dividends. This is according to Simply Safe Dividends, 12-year dividend growth streak. And they have a 9% 20-year CAGR, which is very nice for the chocolate company. And their current dividend yield is 13% below the 5-year average, and the PE is above. So not really a cheap price. I won't say valuation, but not really a cheap price right now, just compared to those metrics. Again, you can't really tell valuation off of stuff like the PE ratio. That's just telling us price. So price and value are two separate things, of course. Number tres is, look at those Sour Patch Kids. Now, this is Mondelez. Mondelez has a bunch of, they're a big conglomerate. They're all over the world. They're all over the globe. But Sour Patch Kids, one of my favorite. And Mondelez gets a dividend safety score of 66. They have a dividend yield of 2.79%. Yeah, Mondelez, I don't own them outright. Pretty quick dividend growth. They're still doing better than the market, only down 15.29% is Mondelez compared to the market down 23%. 9% 20-year CAGR, just like Hershey, but they've only been growing that dividend for 8 years. And I believe that is when they, correct me if I'm wrong, they spun out of Kraft Heinz. So I know Kraft Heinz separated them out, spun them off, and they've been doing pretty well ever since. Their dividend yield, check that out, 28% above their 5-year average. Their forward PE, 18.9. So it's just a little bit below their 5-year average. And of course, they are buried, if down here at the lower right, they're buried at the low end of their 52-week price range is Mondelez. Number 4, can't read me, I'm blocking it, but yeah, Walmart, they have you covered for Halloween costumes. I guess now you're probably not going to a grocery store. I didn't know of Walmart back in 84, so I got them from the grocery store, my costumes. Walmart, you all know Walmart. Dividend safety score of 90. They don't grow it very fast. They're only down 10%. They're still down less than the market is. They had that huge drop back in early summer when they put out that, that kind of was the bellwether with the with what was to come. They were showing that things weren't looking so rosy during their earnings report, and they dropped. I don't remember what I wanted to say. Why? What was the reason? Inventory, right? Drawing a blank. So 11% 20-year CAGR, but they've really slowed that dividend to a crawl as of late. And this shows 48 years of uninterrupted dividends and 48 years of dividend growth. So Walmart going to be a dividend king. They're just going to keep paying that. But you can see really around 2014, they just started creeping that dividend up, not giving those huge raises, and I think that may be the way it is for a little while. Their dividend is about in line with the 5-year average, and they're a little bit below on the PE range. So, yeah, they're probably about a fair value. Looking at, again, obviously, I said we can't compare, value and price are two different things, but looking at the PE from 5 years, they're about probably a good price to jump in here. Number 5, some favorites here that everybody likes. When I was a kid, I was a huge fan of Nerds, Butterfingers, and Gobstoppers, all brought to you currently by Nestle, ticker SNRGY. So Nestle is a company that all y'all probably love and know. Dividend safety score of 99 with a 2.35% yield. And I don't own Nestle. They always seem expensive to me, and I've never owned them outright. So, but thankfully I have in my retirement account, I have exposure to them through some Vanguard Etfs. Down, basically, they're down in line with the market. They're down 22.8% to the S&P's 23.17. 20-year CAGR, 8%. 21-year dividend growth streak for Nestle. Solid company, I think, and they don't really go on sale all that much. And you can tell that by the 5-year dividend yield is about 5% above the 5-year average. That's a lot of fives, and their PE is not too bad. But look at the 52-week price range. They are squarely at the low end, so they're at 52-week lows as well. And yeah, this might be an interesting company if you want to get into a little bit of an international play here. Mr. International Man of Mystery. All right, this one we don't have the company logo on here, but number 6, take a minute, try and guess it. While I take a sip of my water. It's Walgreens. Walgreens, ticker WBA. They got decor accessories, the toys, cards, candy, old people stuff, Werther's Original. I think in the state of Illinois, it's a law that if you're over the age of 75, you have to have Werther's Original in your house at least. I don't think you have to have it out, but it is punishable. I think it's a misdemeanor if you're found to be over 75 and you don't have any Werthers in the house. So always remember that if you live here in Illinois, JK, of course. Dividend safety score of 79. Now, Walgreens does report earnings this Thursday, and from what I read, they're going to outline the trajectory of the growth of their core business. So it's going to be a little bit of a longer earnings call from what I've seen. And early options trading show it could be a 7% swing in either direction for good old WBA. And yeah, you're probably noticing that fat yield. Walgreens down 40% year to date with dividends included. So they have had a rough ride, which is why that yield is really high. 90 years of uninterrupted dividends. Got to give it to Walgreens. 46 years of growth. And they just gave a token increase. You see up here to the left in July of 2022, a 0.5% increase. It still counts. It's still an increase. So that dividend growth streak remains intact. But it's 46 years. I think they want to be dividend kings. But 14% 20-year CAGR on old Walgreens. And that dividend yield, 78% above their 5-year average. Their PE is only 7. You're paying $7 for every $1 of Walgreens' earnings currently. And they are at a 52-week low of $30.52 was Walgreens. Moving it on along, people. Interesting company here. Halloween wouldn't be Halloween without Tootsie Roll, ticker TR. And they have stuff like Andy's, Sugar Daddy. What else do we got here? The Blow Pops, Double Bubble. Remember playing baseball, those. Sweet Pops. And obviously you can go back and Wacko Wax. Look at that. So Tootsie Roll, by the way, tons and tons of candy. That's all they do, right? Dividend safety score of 99. Now that yield of 1.07% can be a little bit tricky because they have had since 1971. I did a video on this. They've had 50 years of dividend splits every year, not dividend splits, stock splits. Every year they split that stock 103 for 100. So if you have 100 shares, you will now have 103 shares. And if you were to sell those 3 shares every year, then that yield, I believe, pops up over 3%. So you're getting 3 free shares basically every year. And again, if you don't know, when we see a company split their stock, the share price goes lower, the pizza pie remains the same, the valuation of the company doesn't change, the market cap doesn't change, and we just have cheaper shares, or not cheaper, their price is lower, which could attract more investors, and more people coming in and buying could push it up. So Tootsie Roll is only down 7% this year. So they've hung in there like champ in regards of how far down some of these other companies like Walgreens was. Not a lot of growth. Again, 4% 20-year CAGR. So this is just steady Eddie dividend stock. You're not going to expect crazy growth. We're buying it for the stock splits and for those dividends. And every year they grow that dividend. 56 years, they are a dividend king. Again, not a huge yield. And they are in line with their, well, about what, 3% above their 5-year average. And look at that. Their 52-week range is right in the middle. They're only between $30 and $37 at 33 currently, so they don't move a lot. All right, let's move along. We're getting there. Number 8. Ticker Tgt Target. Just like Walmart, they got your candy, they got your costumes. What else they got? I don't know. Decor. They got all the same stuff as pretty much Walgreens and Walmart does as well. Target dividend safety score of 90. They're another one I was adding when we were in the summer. I added some at 139. I'd like to buy in the 130s again. They do grow that dividend pretty quick. Down 33% year to date. They had that same monster drop right here, as did Walmart. They pretty much were a sympathy, not play, but they fell along with Walmart did. 20% raise. Management, I love this. Management is basically showing confidence in the company by saying, like, yeah, we got inventory issues and supply chain issues, and we're working through some stuff, but we're confident in this company and we're giving it a 20% increase. And their 20-year CAGR is 14%, and they are a new dividend king. Their current yield for Target is 17% above the 5-year average. Again, 139.30. So I'd almost bought at the 52-week low. I'd like to buy a little bit more down there, but they do look to be on sale. Number 9, Utz. My kids love getting the Halloween pretzels from Utz. You might not have expected this to be on there, but we got Utz checking in at number 9. They have a current yield of 1.51%. They're a recent company. I know Ian Lopik was buying these, and he did they're a SPAC, I believe, is how they came to market. So they kind of circumnavigated the process that companies would use, like the roadshow and listing on an IPO and all that. But dividend safety score, they give them 50, borderline safe. Utz down 14% year to date, total return. Dividend growth, only 1 year. Again, they just pretty much came on as SPAC. This is showing 2019, so that must have been right about when. Don't know if I have my dates exactly right for all y'all. Utz dividend yield 28% above their 5-year. Currently, they are closer to the lower end of the 52-week range, but only $14.32 a share. So interesting company to check out. And last but not least, place to go to buy candy is Kroger. Your one-stop Halloween shop, so they say, is Kroger. And Kroger, dividend safety score of 71, dividend yield of 2.42%, 24% dividend growth streak. Can you tell I'm starting to like, hey, are these people dropping off? Anyways, they're only down 3% year to date, so they've hung in like a champ. Also, they have a 15-year growth streak, 14% CAGR, and what we're trying to say is a 24% increase was that last raise, which was really solid. And their current yield is 18% above their 5-year average. And they look to be at a good place to buy. I think Kroger is a solid stock, one I also do not own outright. And with that, my fine feathered friends, I have a word to the wise of you to stop your pumpkin futures. If you have pumpkin futures, make sure you sell them on October 31st or before. Lesson that I learned the hard way. So, all right, here we go. Remove that. Well, we made it. And yeah. All right, let me see what you guys had to say. So let me know what do you think of that? Was that too long? I don't know. I'm still learning and playing this out. I'd like to hear again. Share me your top dividend stocks that you think are Halloween or your favorite candies. I'd like to know that. And let's see. Here we go. Yep. Love it, Steve. Yeah, T's scary how far it's fallen. But, I almost bought some more AT&T. I did buy more Verizon. I bought 2 shares of Verizon. What was that? Two shares of Verizon at $37 a share. I think that yields like 6.5% now. Ridiculous. Hello, everybody. Hello, Shamir from Canada. Oh, yeah. Oh, buddy. He's a Habs fan. So the Habs are the Canadians, for those of you that don't watch hockey. Yeah. Oh, for Bedard. Tank hard for Bedard, right? This won't tie in. This is just for Shamir and me, but I think the Hawks are going to be trading Kane and Taves. They already got rid of Kirby Doc. They've gotten, or was it Doc? Oh my God. My brain goes when I get these lights on and stuff. Anyway, the Hawks have traded off some prospects. They're trying to tank harder, I think. Mississippi, I love it. Yeah, Steven, I forgot you were in Mississippi. There we go, Ryan. We're supposed to be doing a thing tomorrow night with Ryan, and yeah, Hershey is a beast, and they're unfortunately, they don't really go on sale all that much. Yeah, Hershey and Mondelez come in handy. Nice. Mariusz. I don't remember how to say her name. But Let's see. All right, you guys are saying what's up, what's up. And yeah, let me know. Do you want me to look up anything for you on Simply Safe? What have you been buying this week? Let me know what you've been buying. And oh, Canadian Thanksgiving. All right, that's right. I thought when's Boxing Day? Isn't that on that's in December, right? I don't know what Boxing Day is, so yeah, spun off in 2012. So that was right. They're spun off of Kraft Heinz, I do believe. You have Walmart. Yeah. Let's see. Oh, thank you guys. Again, thanks for smashing the like button. Even if you're watching on the replay and you're still with us and you didn't check out. So that's kind of what I'm doing. I just wanted to get right into the content, what I prepared, and then people, on the replay they don't have to watch this if they don't want to. But if you are, what's up, future people? We're all watching you saying hello from the past. And like I say on the podcast, right? You can never live in the past. You can never be in the future. You can only be in the present. So really all that ever exists is right here, right now in the present. Even those things, well, not things, but like Julius Caesar, Abraham Lincoln, the great pharaohs, they all currently still reside right here in the present, just in a different form. So we're still in this form where I'm able to communicate with you. And if I was communicating with them, that would be a whole different show. Perfect for Halloween. If I was able to speak with Emperor Nero and have him on the program, I'd probably have 10 billion. Well, that's not that many people. How many people on the planet? Anyway, yeah, that would be great. I'll work on that. I'll work on it. Let's see. Nestle's on the watch list. Not yet available in the brokerage. Okay. Yeah, Nestle is, I don't know. Nestle is one again that I kind of feels like Hershey. They very rarely look like they're on sale, but they're getting there. They're definitely getting there. Ah, look at this. He started a position in Pep. I'll drink to that. By the way, on Wednesday, PepsiCo has their earnings, so I'm going to be super excited for that. Maybe I'll do a quick video if something interesting happens. I know the last one I tried to get cute, and I thought it was really interesting, though, for me that Ramon LaGuardia, the CEO of PepsiCo, had said non-sugar is king. And this is why I say it's so awesome to invest. It's such fun because we never know the exact direction that the consumers are going to push these trends and what they want. And companies, because they need to make money, are going to try to meet that consumer demand. So I think it's really cool getting to watch a company like PepsiCo really pivot into the non-sugar. Now, granted, I'm not a big fan of the aspartame and some of the sugar substitutes, but yeah. Thoughts on the dollar store chains? They'll do well. I know Dollar Tree doesn't pay a dividend. But see, this is funny. Like, I get in the mindset, I'm so into the passive income and trying to add on to that passive income that I'll turn a blind eye to companies like Dollar Tree and, what's the other one? Not Five Below. I can't think of it. Somebody tell me. Is that where you got that? I actually was on a message board a few years ago, and I remember somebody mentioning about the pumpkin futures. So that's probably where it's from. I didn't even see that, but I did steal that from somebody in a message board a while ago. Okay, good. Thanks, Steve. I'm glad. Spent this morning putting that together and a little bit of last night. Mondelez, WBA, and Target. Yep. Let's see. Yeah. Okay. So I was right. So how are you guys going to tank when Doc got sent to the Habs? I thought so. Yes. Okay. Here we go. All right. Billy. Let's see. He brought Air Products, Union Pacific, Snap-on, Leggett & Platt, Altria, Stanley Black & Decker, Whirlpool, Citigroup, and Amgen. All solid companies. I do own outright Snap-on, Leggett & Platt, and Altria. That's what I was trying to say. Out of those, my favorite is Snap-on right now. They look super strong. All those companies, you can make a case for them, and with good reason. The only one I might be worried about is Whirlpool. I think if we're heading into a recession, I don't really know their business. I know my guy Kevin Burgess did a video on them where he kind of dug into them a little bit more. But I'd be curious to see Whirlpool. Actually, I'm going to look at Whirlpool to see if what their recession return was. And let me bring y'all along. Come on, everybody. Oh, and by the way, I'm doing this show today because I'm working tomorrow. I got a job that popped up, and time and 3/4 I will not pass up. There we go. Whirlpool, 5% dividend yield. Okay, that's nice. Let's see here. So I will show you this cool thing that they share on Simply Safe. Whoa. Their recession sales actually were negative 16.9% during the 07 to 09 Great Recession. They maintained the dividend, so they didn't cut it. And their recession return this is what worries me. But if you're holding for years and you can imagine holding after and through the recession, however long it lasts, they had a negative 78% recession return, while the S&P 500 was negative 55%. And since I'm here, we'll just take 25% growth in February of 2022, 11-year growth streak. Currently paying $7 per share, which means their share price is probably in the hundreds, right? Sorry if this is going to make you sick. 138.73. And they are 60% above their 5-year average of 3.16%. Oh, cool. Yeah, and they are at a 52-week low. Well, technically, yeah, they're at almost 138.73. Their low was 134. So very interesting. Let me see their payout ratio. It's so hard for me to not scroll. 47% free cash flow payout ratio that's a nice. $13.40 dropped from $26. And sales is declining a bit. 59 shares. So this is why their share price is quote unquote expensive in the hundreds, because they only have 59 million shares outstanding. So they are buying back shares. Fun thing, I don't know if you're aware, but when companies buy back shares, they can either cancel them or they can put them into treasury shares or treasury stock. I think it's treasury stock, but if it's in treasury stock, it doesn't reduce the shares outstanding. It's just bringing them back into the company. So I don't know if they are canceling shares or just putting those in treasury stock, but either way, their share count is reducing. And let me just see their 20% ROIC. All right, so I'm playing around. 11.8 interest coverage ratio. All right, that's good. I like that. Should be over 8. All right, what we got here? Thanks for sharing that, Billy. Appreciate it, man. Boxing Day is December 26th. Shows what I know. I'm not Canadian, so let's see. Steven, his cost per share of VZ is about 50. Buy now to lower it. Dude, it can go way lower, but I know that I was buying it in the low 50s with you. I was buying it in the high 40s, the low 50s. So the rule of thumb that I play by is I know the story of why I'm buying something. And if the share price drops and the story remains unchanged, then buy more. But if the price drops and the story does change, then do not buy more, and you probably should consider selling. So for whatever reason you bought Verizon, if that reason has not changed, then I would absolutely buy some more, but only you're going to be able to answer that. So I hope that makes a little bit of sense. I bought ARE and Comcast, waiting on Target, Microsoft, and KLA to drop more. Yeah, I'm waiting on Microsoft as well. I'd love them around 200, and I might be a little bit, let's see. Why does monetization have to be done? And this is Cody from Citizen of the Year channel. Definitely write it down, take notes, check his channel out when, we're done with this. It's down. You know what? I guess I've noticed, but I don't know. For me, this is where it's kind of nice that I'm not relying on, like, literally all this is just a hobby for me. And I don't need the YouTube money to do anything. And really what the YouTube money is doing right now is paying for, it's paying for Simply Safe dividends, which runs me $400 for bills. It runs me $400 a year. So I'm pretty much plowing first and foremost all the money into that. So I can do stuff like the live stream. And, if you want me to look up something, we'll look it up, or email me. I'll tell you something, Russ at dapperdividends.com. Let me put that in there. It's in the show notes, but let's see. There we go. Hopefully I typed that out right as I'm talking to all y'all. Yeah, I don't know. Oh, I know why it's down. What am I saying? I think I know why it's down because of the recession that's coming. One of the first things to go in recessions is spending for companies, the advertising spend. So that ad spend will drop. And hey, we're as YouTubers, we're making our money off of the ad spend. So when companies will pay less to advertise, that means it's going to be less for us. So yeah, it stinks, but whatever. It is what it is. And I'm just trying to keep improving the content, connecting with more of people in the investing community, and especially the dividend growth, passive investing community. And yeah, Dollar General. No, there's one more. It's Dollar General and everything's $1, but they're not publicly traded, right? Yeah, and they raised everything to $1.25, I think. Florin, hey, we're the PG people. I bought one more share of PG. That's the 10th in the bridge in the taxable. I have 10 now. 125.50 I bought it at, and then it promptly dropped to below 125. So keeping an eye on Waste Management, Honeywell, and PepsiCo. I own 2 out of those 3. Waste Management, definitely solid company. By the way, this show brought to you by Lakefront, our friends at Lakefront Brewery during Sober October, which I am participating in for the 3rd year in a row. What's up? Let's go. Here we go. Spectacular Saratoga Springs, New York. It sounds, as soon as I see Saratoga, I think like palm trees and sunny, and then I see New York, and I'm like, I'm sure it's beautiful. New York is a beautiful state. I've never been there actually. Full color glory. Tootsie Roll, pretty much steady. Yep, steady Eddie, unchanged. Their annual 3% stock divvy. So with that 3%, you're factoring in the annual stock split, right? A lot of people don't know that. It's why I did that video that was all mucked up and goofed up not too long ago on it. And yeah, they split 103 for 100. So if you have 1 share, I believe you get 1.03 shares. And if you have 100 shares, you'll get 103 shares back every year. So yeah, but then you couple that. But if you were to sell those 3 shares you got plus the dividend, then I think it's over 3%, I believe. So yeah, Procter & Gamble and AGM next week. Still have to vote my shares. Do you do that? Do you vote? I don't vote. I've never voted. Have any of you ever voted? I've never done it. I don't know why. Maybe I'm too busy and I think it's not going to matter. But yeah, I'd love to know if any of you guys have voted. Dude, MPW, down, down, down. So I do know that there was a short report that came out. I don't know if you guys follow Bear Cave, Edwin Dorsey from the Bear Cave. I get his email, and there's problems at MPW. Basically, you know what? Since you are cool, I will show you here. Why don't you guys follow me and watch me stumble and bumble to get to one of the things that I was reading. Here we go. All right. So let's do this. MPW. It was a really nice, it's in the news here of their summary. I just saw it. Here we go. All right. Click on clock. I can't say click today. Where is it? They gave a little. Here you go. So medical properties slumped 6.2%. The Bear Cave Substack mentioned it cautiously. One of its tenants, Pipeline Health, filed for Chapter 11 bankruptcy protection on Monday on their Q2 2021 earnings call. So a little over a year ago, their CEO said he saw very limited downside to its investments in Pipeline Health because it had operated its hospitals, quote, very, very profitably. Medical properties didn't immediately respond. We're not going to look. So earlier on Thursday, Medical Properties agreed to sell 3 Connecticut hospitals for $457 million. That is them. And then, I can't share that. I can't switch off. Yeah, so I'll just tell you what Simply Safe rates them as. So basically 70, they give it safe, but Yeah, so Rocco, what happened with MPW? It looks like management said that Pipeline Health was very strong in their quarter two 21 earnings call. And then this Monday, Pipeline Health filed for bankruptcy. So that I think is why MPW is dropping. And we'd really have to dig into that. Simply Safe or Seeking Alpha, by the way, comment section is great. I get a lot of ideas and there's things I've missed. I don't know if you can access their comments without a what's the word I'm looking for? I wonder if I can copy and paste the link here. Let's see. Try this. Let me do this. I wonder if this link will go through. So I wonder if you can copy this link and click on it and then read the comments, because the comments are awesome. That one looked like it had 127 comments on it. So I would say really read through the comments, because the people that invest in medical property trust are going to go through there. And I don't know if that link, let me know if you want to try it. Go ahead. I don't care. Let me know if that link works and you can read the comments out there. Let's see. Hey, my buddy. You're gonna make me say it again. All right, let's see here. I'm gonna do it. I'm gonna say it. Das Kapital Kapital. God bless it. Das Kapital ist ein Schweinchen. I want to swear. No, I know it's bad and it's butchering it, but I can't even speak English right now. Butchering it. Bought some MOWI stocks last week. I don't know what MOWI is, man. Let me see here for my own OV. It's a packaged food company it's a seafood company. Nice. And they are headquartered in Bergen, Norway. Norway. All right, let's see. I'm going to catch up. Look at this. Kevin Mendoza bought a lot of tea. Hey, man, I think the cheaper it gets, the less risky it gets. And for those of us that are weighed down, I think Verizon is a little bit stronger. I think Verizon is still the United States' biggest or largest cell phone provider company. That may be right, I hope. Take that with a grain of salt. But I bought more Verizon, and I think they're a little bit stronger than AT&T, but I do have, I think after that, there was like $12 or $13 left in the bridge. And I thought, if I had like $3 more, I probably just would have bought another share of tea. But we'll see. Hey, Jeremy, I got to have him back on the show. Let's see. Trying to type in here. All right. So Jeremy runs a blog called Dividend Stockpile. Definitely check it out. And he does vote. I don't vote. I should vote. So, oh, dude, look at this. Hold on. Steven gave a $5. Let's see. Oh my God, man. Thank you. Steven gave, I will look up Ally. He's buying SoFi, doesn't pay a dividend. Hold on here. I'm going to do this for you, Steven. Here we go. This is for you. Thank you for the dividend, Steven. Thanks for the dividend, Steven. I was going to do more of a song, but I don't know. Come up with something on the fly. That'll get old. I worry about people that are tuning in. It's supposed to be about dividends and some lunatics playing the guitar, but little bitty nonsense there for you. And yeah, we'll do it, man. Again, thank you so much for that. I really do appreciate that. That is so very kind of you. And without further ado, we will whisk you. Do you guys remember Mr. Rogers' Neighborhood when he would go to the land of make-believe, right? Or is that town? Boy, the mind. And he would play the music with the little xylophone or something. Anyway, okay, enough jabber John, man. All right, check it out. So you want to look up Ally. We will do that for you. Let's see. Ally. 4.12%. Let me blow this up for you. I don't know. Maybe you're like me and you're getting older eyes. Try and put it over to that side. So I got my little phone next to me. See how that looks. Give it a second here. That looks good. Okay. make it easier for you to read if you're on mobile. All right, so Ally, borderline safe score 50, 4.12% dividend yield, growing it pretty fast, 20% growth in January of 2022. Recession sales negative 62% during the last recession. Now, I don't know because I know that Ally used to be GE, right? They were like the financing arm of GE. Let me see. I'm sure they'll tell. Let's see when they. Sorry about this. If this is making you. I want to see what year that was. That they. It doesn't. Oh, here. Formerly known as GMAC and changed its name to Ally Financial in May of 2010. They were founded in 1919. Yeah, so they were GM's financing division, I guess, or the financing arm. So 2010. So this, I believe, was before they were their own entity, obviously. So that's interesting to know, though. Dividend growth, 41% CAGR the last 5 years. We'll see if they can keep that up. I know I've been seeing chatter about them as an interesting stock to buy. Currently $1.20 per share, 30 cents per share per quarter. Yeah, man, that yield is currently 84% above their 5-year average. And that's pretty stout. $27 a share. They're really close to the 52-week price, right? Dude, their PE is only 4.3. Look at that. Their yield is almost the exact same as the PE, the forward PE. I don't know if the last time I've seen that. That's pretty freaking low. And yeah, Ally is looking really good, man, for at least a, let's see. Yeah, free cash flow. You can't really look at that for banks. So let's look at their earnings payout ratio is 18% coming up. So that is really stupidly low. Let's see, free cash. They're making money after losing a couple years in a row down there. Earnings per share, $6.68. So they're easily able to cover that dividend. Sales have really tailed off. That's interesting. So I think the rate increases is going to potentially hurt that because it's going to make debt more expensive. And if they're a financial institution and they're lending money, it means they're going to have to charge higher interest. Obviously, a law of economics, people want to pay less for things that cost more. So, but that's what the Fed's doing. They're not government. The Fed, they're neither federal nor do they have any reserves. So that's what the Fed's doing. They're trying to destroy the demand, right? Make things more expensive so we slow down the economy. Shares outstanding, 343 million. But yeah, look at their sales, man. Jumped up, $8.46. And return on equity, nice. And then debt doesn't really make sense. That debt is what they need. Like that's their source of how they make money. So Ally, interesting. They only give it a 50 though. So I wouldn't mind owning a few shares of Ally, man. So I hope that helps. And yeah, what do you guys think of? What do you guys think of Ally? Are you buying Ally? Can't get my NHL straight. Oh my God. Oh my God. All right. What do we got here? So we were talking about voting. Shamir tends to, even though he doesn't vote. Oh, he does. Vote doesn't matter. Whenever BlackRock does is what matters. Interesting. So here we go. Harris Malberg. He has a podcast, One Penny at a Time. And we are supposed to chat tomorrow. So I'm going to go on his podcast. I may use the audio for mine if that's okay with him. But yeah, excited, man. And I'll message you later. But yeah, we'll set up a time. Again, I'm working. I'm going to be home early afternoon. So that will be all good. All right, let's see. Jer. All right, what do you got, Jeremy? Check out BDJ. Special div. Is it too late to get into that special div? Let's throw it up quickly. I say quickly, but you guys know me, how things go with Das Cap. I will call him Das Cap. Das Kapital. Wasn't that Marx? Wasn't that Marx's book, Das Kapital? All right, BDJ, right? BDJ. Oh, you're closed-end funds. Jeremy likes his closed-end funds. I don't invest in any get a dividend safety score of 50, borderline safe. I just don't know enough about the closed ends. Let's see, premium to NAV, negative 5%. So, Jeremy, that we want to buy, I always forget, and I think I know, we want to buy that when it's positive, right? The premium to the net asset value, I believe. See, this is interesting. They just started covering closed-end funds here, but let's see their dividend growth. Yeah, 12% increase last, negative 2% 10 years. So I don't know enough about these. Yeah, you're right. 0.0562, which they've been paying since, looks like they pay it every month. It's a monthly dividend stock. Interesting. And there's the specials, December 15th. So here you go, everybody. The ex-dividend date for what Jeremy was talking about is December 15th. So if you want to get that special dividend, but always remember, when a company pays a special dividend, the next trading day on the ex-dividend day, their share price is going to drop by the amount of either the dividend and or the special dividend, like we saw with Lyondell Basel. All right, let's see. Call him Das Cop. I will. God bless. And here we go. Thank you, Spambot, for coming in and putting this stuff on there. I try and block it, but put user in timeout. We'll block it. All right, let's see. I missed this. Hey, Justin, what's up, man? He's been investing in Ally. Oh, that's right. I knew somebody was talking about Ally, trying to get it to 100 shares. Cool. Journeyman, not buying tier VZ because I have Intel. Yeah, dude, it's been painful with those. And again, if you guys follow Intel, they had said during their last earnings call that they expected Q2 and Q3 to be ugly and the bottom. So we will see. But obviously, with, the end of the year can help make a lot of things look better because of all the economic activity for the holidays. And we'll see how that works. Look at this, Phil B. He bought a few shares of 3M. I did notice 3M at 109, right? They were under 110. And I told everybody that I could see them getting into the 90s, and I may add a few more in the 90s. But again, a lot of litigation coming with 3M. I think it's going to be messy and ugly, and I would not fault anyone for just cutting your losses. Actually, I was thinking about tax loss harvesting at the end of the year. I'm going to see how much more I have left. If you guys don't know what tax loss harvesting is, in a nutshell, what you're doing is you're selling stocks you're down on in taxable accounts, and then up to $3,000, you can claim that loss when you realize it, meaning you've sold and you've actualized that loss. You've realized that up to $3,000, you can lower your taxable income. So real quick example, if you had $3,000 of dividend income on the nose, you would be paying taxes on that, right? Well, if you tax loss harvest and you sold enough stock that you were down exactly $3,000 on, it would completely cancel out that, and you wouldn't pay any taxes because it's a wash. But if you buy that same thing, so if I were to sell 3M and I bought 3M again in any account, it could even be a retirement account, but if I bought 3M in the next 31 days, it will violate the wash rule, and you can't claim that as a tax loss anymore. So what a lot of people like to do is they'll put it into something similar. Easiest example, if you wanted to tax loss on ExxonMobil, which nobody's doing now because it's up through the roof. But theoretically, if you tax loss harvested on ExxonMobil, you could just right away, minutes later, buy shares of Chevron and then hold Chevron for 31 days. Because if something happens, obviously, most likely, those are going to go up in tandem. So long way of saying that I think that I might tax loss harvest 3M. So on December 30th, I may sell them and then I'll buy them. I'll just wait till February 1st or something just to make sure. But yeah, it's going to be ugly with 3M. And I think a lot of people are going to be tax loss harvesting. So I think I would hold off. If you want to start a position in 3M, it could benefit you to wait until January, till everybody's done tax loss harvesting, and we'll see what that does. Yeah, buddy, I love Mr. Rogers too. Fred Rogers was awesome. Really good book, biography I read on him. Rocco used the link. Good, I'm glad. And oh, my Starbucks Investor Day video. Yeah, that one was interesting. I enjoyed it, but I don't know if the juice was worth the squeeze. Do you know what I mean? So I don't mind doing it, but it was a lot more work on my end. And I think I made it too long somehow. But it's hard for me because it's like everything they're saying I think is important. So I don't want to just repost the video, but I was trying to find out like the most important things. They say a lot of fluff and whatnot, but I don't know. Oh, interesting. Okay. Clowning. We love clowning. You're always welcome, buddy. You're always welcome. They car loan. So how do they do in a recession would be important. Yeah. I don't think a lot of people are buying new cars. I mean, right? Like that's what I would be thinking is that, I mean, mortgage rates are up. So people aren't pulling out money to fix their house or get the newest model of car they're driving or a new car. So I would think that it's the same thing when interest rates rise across the board. It just makes borrowing money more expensive. And I don't think that most people are paying or buying their new cars with cash. They're financing it. So nice. See, I didn't know this. Ally's the largest auto lender in the world. Yeah. So that's going to be interesting. Okay, here we go. Back to our BDJ, the closed-end fund. I was completely wrong on that. So thank you, Jeremy. I don't know why I can't get that through my thick head. So when you see that negative, so that is a deal on BDJ then, is what we're saying. Yes. Rocco, Intel, bottomless pit for the next year or so. Long-term, probably more promising and still can go lower. I always wonder, is there a company that's going to buy Intel? They're around 20. That, I don't know. That'd be awesome. I'd probably add more if it was around 20, maybe a couple $100 more, 5-10 shares just to average down a little more. But at this point, I'm completely fine holding for 5, 6, 7 years unless something completely goes haywire and they look like they're about to go bankrupt, but they're not. They're getting the Inflation Reduction Act money, right? They're getting that government funding for building their fabs. And I think they're going to be okay in the long run. It's just going to be a little bit during this transition time. It's going to be a little bit icky. Hey, I got a question. Who would you guys? It's been a while since I've talked to somebody live. Maybe next week, and I'll beat around the bush. Who would you guys like to see me talk live with or bring on the channel? And what would you want to hear talked about? Well, obviously within reason. I mean, I can only got so much pull here, people, who I can get. But yeah, I don't know if it'll be on the channel tomorrow. So if everything works out, Ryan Williams, Darth Dividend, and myself will be doing something. Yeah, Katie, that's what I was going to say. I thought about saying Elon. So, hey, I could send him an email. I'll hit him up on Twitter. I'll just slide into his DMs and say, hey, if you're not doing anything, you want to pop onto the channel. Oh my God. Could you, I'll do it. You know what? Screw it. I know he doesn't control, or he does look at his Twitter. Anyway, we'll see. Maybe he'll come on the channel and talk to me. That'd be nutty. Let's see. I suspect investors will also use Meta for tax loss harvesting. Yep. Considering it for his Meta position. Why not, right? I mean, what would you buy instead? So if you tax loss harvested Meta, what are you doing with that cash for the next 31 days? Are you going to, I don't know, what would be comparable to Meta? I mean, I don't think you put it in Twitter or, I mean, they're a unique company. No, dude, what's unique about them? They have what, 3 billion or so active users or something nutty. Okay, here we go. I love it. On MLPs, K1's a big deal. Let's see, avoiding them because I'm ignorant in that space. Yeah, so MLPs can be a little bit of a headache. Honestly, if you have the, I would say 10-second, but I can't say it in 10 seconds. Honestly, with MLPs, to avoid the K1, if you can, I would buy MLPs. Like I think EPD is a MLP. Cedar Fair is an MLP, but I don't know if they're paying a dividend again yet. I would hold those in a tax advantage account. So like your 401k or a Roth, because as long as you're under $1,000 in MLP dividend income per year, you're not going to get a K1, but $1,001, and then you will on that $1 on that first dollar. So I would say as long as you're under $1,000 a year in MLP dividend income, I would try to hold it in a retirement account. Just my, Google. What am I thinking? Yeah, Katie, I love it. Yeah, Elon Musk. I wish Pee-wee, dude, I'm going to fix that. By the way, with my podcast, I listen back to it. I'm done recording on Anchor. It's just easy for me, but what it does, and I can't stand it, when I stop talking, it like turns up its listening, I guess. That's a bad way to describe it. And then I speak and then it's like distorted and then it corrects. So I'm going to use something else. Yeah, PPC Ian. So funny enough, him and I had, when he did my PepsiCo intro, he said, "Hey, I'm just moved and we should chat sometime." And I was like, "Yeah," but I never followed up. So maybe I should send a guy a message. You too, Jeremy. We should chat again. It's easier with two people. Like, you can hear me. I'm starting to get like, you sit here and talk for an hour straight like a lunatic. All right, I wanted to know this. Yeah, Journeyman's going to buy Google with the money he gets from selling Meta. That's a good one, right? Because chances are, if Meta starts popping, Google's probably going to pop. But yeah, exactly. That's good example. Yeah, JJ, I can try and send him a message. I think I talked to him once on Twitter, but yeah, I can see. Here we go. Yeah, I don't really deal with K1, so Jeremy, this is why I love to have him on. Easy with tax software. Problem is that the paperwork is always sent late, so you never know when you can file your taxes. I don't know if I should say this, but I'm going to. The very first time I got a K1, we had already filed our taxes, and then we got the K1 in the mail, and I didn't do anything. And that was in 2020. So, I don't know, whatever. If the IRS is going to get nitpicky and come after me for a few bucks. Whoa, what happened? I went out of focus. Hello, I'm over here now. Oh, I never got rid of this guy. This not stupid guy, old Ben Franklin. Anyway, so, all right, got a few more minutes left. Oh, by the way, I didn't say it. If you're still watching, I'm going to go in when this video is done, and I'm allowed to, but I had a video I did last Halloween with 7 investing tips from Michael Myers. I had a fun time making that video, so I'm going to link that up here when I'm done. Yes, I will look at that for you. For you, Mariusz? I'll stop saying it. All right, let me see here. Let's bring you all along with me. Get my guitar and play that. All right, AMAT. I've never looked at AMAT, so this will be fun. This will be a popping my AMAT cherry here, looking at it. Applied Materials. Okay, I've heard of them, but I don't think I've ever looked into them. Dividend safety score of 86. Only a 1.26% yield, but they are growing it fast. So remember, we're okay with lower yields as long as they're growing them fast, which they are. $71 billion market cap. Let me see when they were brought about. 1967. Interesting. Headquartered in Santa Clara. Beautiful. Santa Clara, California. Negative 38% recession sales. They maintained the dividend during that time. They were about the same as the market during the last recession. Dividend growth, 8.3%. Shrink this a little bit. All right, 8.3, 12% 10-year CAGR. All right, huge jump there from 16 to 17. 4-year growth. Yeah, because it was flat there from, 14 to when they raised it. 16 years uninterrupted. $1.04 per share. And their dividend is about 8% below the 5-year average. That and their PE is below. So they're about, oh, okay. Look at that. Like most semiconductors getting hit hard. They are at the low end of the 52-week range. Free cash flow, only 18% payout ratio. Earnings is that is so low. How low? Low as you can go. Free cash flow, $5.58 a share. Sales is dropped down a little bit, but still 16% sales growth, nothing to sneeze at. Shares outstanding been dropping nicely down to 889 million. Sales going up and to the right. We'd love to see that. High ROE and ROIC. Their free cash flow margin, sorry about my bopping all around. Nice, 14%. I like it. So they have good margins and not a ton of debt, 17%. That's pretty low. And they have a ton of cash, $32.94 of operating income for every $1 of interest expense. They can easily pay the interest on the debt. And yeah, that looks good. I will end it with Jeremy saying it's a good value right now. I do believe it looks like it is. And hey, make sure you check out. I don't know if I'm hosting this thing tomorrow night or if Ryan is or Darth is. One of us will be. So as long as you follow the three of us, I'm sure you'll get the alert. And I don't know what we're going to talk about. I'm going to push for us. Hey, all right. Well, those of you watching, what do you want to hear us talk about? Give me a few ideas that I can bring up with them. I was thinking of what is one stock that we don't own right now that we would like to buy or are on the verge of buying. Any stock, doesn't even have to be dividends. I'd like to know that from them. But yeah, you know what this is like? This is so, you won't be able to see this. So they're saying at Lakefront is, I could just tell you one more, then we go. One more, then we go. That's how this feels. One more question, then we go. All right, I'm going to write that down, Journeyman. Stocks to avoid. Stocks to avoid, man. All right. And then Florin, thinking of PPG. You don't own PPG. Okay. Yeah, Pittsburgh plate glass or paint and glass? Plate glass. Yeah. All right, here we go. Then 2023 goals for investment. Goals. All right, cool. And let's see. And Harris. I'm going to write these down. I'm not going to go back in the stream. Non-dividend stocks. Yeah, cool, man. I like that one. Hey, I guess that would be interesting, right? You get 3 dividend investors talking about a non-dividend stock that they like. I know mine right away. I know mine. Super easy, but I'm not going to give it away. All right. Okay. You guys keep coming in. Michael from Slovakia. Dude, you know what this is? Yeah. Oh my God, I can't. There, look. I know it's not Slovakian, but he knows this. Oh, by the way, look at that. Since we're showing tattoos, it's always Halloween around here because I got my pumpkin. I'm Czech. My grandpa, his parents, my great-grandparents were from just outside of Prague, from a town that I cannot pronounce. But yeah, man, dude, happy to have you from Slovakia. We are planning a trip to Prague in the spring, so I'm happy to get over there. Let's see what pharma stock's not bleeding. These are all good questions. Maybe we'll do them all. They'll like it. That'll be less thought for them. Interesting. Fedex or Target. Oh, interesting. I know FedEx has some issues with their balance sheet, but I would stick with Target. Just off the top of my head, everything I've seen, I would feel much more comfortable with Target. Not financial advice, just my little old opinion here. But I would definitely stick with Target because I think FedEx, as I'm looking it up for my own, I think FedEx has just a little bit more debt. Let's see. Yeah, they have 57% debt. So their debt is kind of up there, and their interest coverage ratio is only 8.43. So that's a little bit low. And I just would feel much better with Target personally. Okay, I'm gonna get out of here, guys. It's been 104. I don't want to keep you all day. And yeah, thank you for doing this on a Sunday or Sunday. Hey, thank you for doing this on a Saturday with me. And hey, you even got to hear me play a little guitar. So maybe that'll be a special thing for oh, look at this. All right, I had to yeah, your brothers. Hey man, I love it. You know, that's my heritage. That was something. That was my very first tattoo when I was 21, and I was happy to get that and show my grandpa. And of course, he said, "No more tattoos." He's like, "That's enough. You don't need any more tattoos." So, Tokyo next year. Going to use SCHD to help out with that. Beautiful, man. I love that. So, yeah, I've never been to Tokyo. I was in the Navy, the U.S. Navy, and I was to Australia and Tasmania, a bunch of Middle Eastern ports you guys might never have heard of, and Hawaii. We were supposed to go over to Asia, but we never made it. So, yeah, we'll end with. All right, I'm gonna end it with clowning. If I don't, hey, Leroy, there he is, man. What's up, buddy? So, yeah, you missed it. It's okay. That's why we got the replay, you know. But I still got to talk to you, and I will end with Leroy. So. All right. Now I'm gonna Kevin. All right, guys. I'll just do this all day. This will end up being 5 hours long. So I'm gonna end it. Thanks again. I really do appreciate the donation, Steven. So very nice of you. And I appreciate all you guys stopping by, hanging out, and make sure for whoever stuck around this long in the replay. And when I get to it, you check out the 7 investing tips from Michael Myers. So I love you guys, and I will see you all in the next one. So long, everybody.